So now I'm happy to introduce our keynote speaker with global overview on CBDC, Garіш Натараджан, World Bank. Garіш is a lead financial sector specialist in the finance, competitiveness and innovation global practice at the World Bank. He leads a global team working on payments and market infrastructure topics. Garіš, you are welcome.
Okay, so good morning. Thank you, Governor. Thank you, colleagues from the NBU for inviting me to kind of share my thoughts on CBDC. The Governor was dividing the world into CBDC enthusiasts and CBDC pessimists. I'm a centrist, one of the rare political animals now, so I will try to kind of share a centrist view on CBDC. Currency and money are fundamental concepts in the financial sector and have been taken for granted for over 100 years now. The key component of the ongoing fintech phenomenon has been premised on questioning these basic constructs on which the entire financial system has been built. And it has come to a point where people are questioning what is money, who needs to be issuing it, and how do you experience and how do you use money. So in the next 15 minutes or so, I will go through the linkage between payments and accounts, how they have evolved over a period of time, a general overview of CBDCs and some statistics from a recent BIS study, and also some statistics from a World Bank study, and the risks associated with CBDC, and then drilling down into some of the oft-stated motivations related to CBDC in emerging markets, in particular financial inclusion, and including placing CBDC in the context of various ongoing innovations. So let's start with looking at what's happening, how has the payment to account linkage evolved over a period of time. For a long time, payments was very closely linked to bank accounts. In the last 50 years or so, we started seeing some electronic or digital mechanisms to access the bank account, but it was still, of course, the banks which were maintaining these accounts. So you had the debit cards coming up somewhere in the 1980s, 1990s. Of course, credit cards were much before, but talking about bank accounts, debit cards were introduced around in the 1970s, 80s in the United States, and then, of course, it is very popular all over the world now. And then you started seeing internet banking, and then you have mobile banking. But all of that, you still maintain the connection with the bank account. We started seeing the concept of prepaid accounts somewhere in the early 2000s, basically which kind of created a separate kind of account which is maintained outside, which is pre-funded using money from the bank accounts potentially, or also in cash. And essentially, it opened the door for non-bank players to start issuing payment services. So in that sense, it basically delinked the payment service from a banking activity, allowing non-banks to start offering payment services. And this led to the rise of mobile money across the world. And in particular, in emerging markets, that's been a very important component of financial inclusion. And then we saw the new way which we're seeing now is delinking the payment service from who's maintaining the account. So you could have an institution providing payment services, and that institution doesn't have to be the one which maintains the account. So this is the world of open banking, APIs, and then of course the kind of the Visas and MasterCards of the world, they have devised this technology of tokenization for them to stay relevant in the new era. So what is happening here is that the institution providing the payment services is not responsible for the safekeeping of the funds. It's not responsible for maintaining the account, and in that sense, the regulatory implications for offering payment services are much lower than in the case of prepaid accounts, which I mentioned earlier. And now we are seeing the fourth wave, which is basically delinking the need for an account from the payment service. So if you really look down very closely, the Bitcoin and all the cryptocurrencies, there is no concept of an account, because account means centralization, and these are all decentralized technologies, so you don't need an account for making a payment. Of course, the way you interact with it currently might involve some cryptocurrency exchanges or crypto wallets and so on, but fundamentally, the technology allows you to make a payment without maintaining an account with any institution. And this concept is being, of course, carried forward with stable coins and potentially with CBDCs, depending on how you implement it. Now, what are the implications of all these developments is something to be seen. Of course, the fourth wave is completely uncharted. There are a lot of issues, a lot of research which is being conducted, but it kind of shows how it is evolving. And in some sense, we are coming back to the whole point of cash which was basically not without an account and which you could use as a payment service on its own. In some sense, we are coming back to the same old notion. Starting with now looking at why people are interested in CBDCs. There have been broadly 4 or 5 key motivations. And I'll first make the positive case, and then I'll try to see whether it really holds against some evidence which is coming in from how it could be done differently. So starting with kind of the role of CBDC as a settlement asset. So with the developments in distributed ledger technologies and blockchain and so on, there was a lot of discussions about how do we move the market infrastructures related to security settlements and so on onto the blockchain. And when you move the securities market onto the blockchain or distributed ledger technology, then there is this pain point which remains of how do you settle? How do you settle those transactions? And if you retain the payments leg of the transaction in the traditional payment systems, then there are a lot of issues with respect to efficiency gains. And that was one of the motivations for CBDC, and a lot of banks, in fact, called for it, saying this is one of the key reasons for issuing CBDC. The governor earlier talked about central banks being perceived as bureaucrats and so on. But there's one area in which central banks have traditionally been very creative, and that's with the design of currency. And we see a very similar trend with respect to naming some projects in CBDC. So we have the Canadians calling it Project Jasper. There are various other creative names coming up. And some of these projects actually looked at this concept of looking at the settlement asset and how CBDCs could help in that. The second area is about providing a universal payment mechanism in a cashless economy. And this is the case where if everybody is moving towards cashless transactions, which are being provided in the private sector, then what is the role of the state? And what is the role of the central bank in particular to providing a backstop, a kind of universal mechanism? And my colleague, Bjorn from the Riksbank is here, so I'm sure he will be talking about that. And they, in fact, made a very powerful case for this concept. The next is, which is not talked about much, is this whole world of Internet of Things. So this is the world in which people talk about the refrigerator ordering drinks for you when it kind of detects that you're short of wine and things like that. So there, the question then is, how does a device order by itself? And how do you ensure that it is universal, which is kind of interoperable and so on? And a lot of people make a case that this is a reason why CBDC might also be useful as we move towards a scenario where there are a lot of Internet of Things. The next concept is of programmability of money. The increasing digitization of processes in the financial sector is leading to a scenario where there's a question, why do you need all these rules and procedures which are often enforced by institutional arrangements and kind of contractual structures? And there's a question of why do you really need that? Can you really program that into the actual funds transfer leg itself? And this is, of course, the world of smart contracts and things like that. And it has applications on delivery versus payment, payment versus payment, and then also in cases where the government wants to earmark particular uses of money. And a lot of people have written about this, where you could actually program into the money that it can only be used for certain purposes. And some people have said that that could help in corruption. And then is, of course, this topic of additional monetary policy instrument. Some people talk about CBDCs kind of being able to break away from the zero low bound, and then also increase the effectiveness of quantitative easing and so on. And the governor also referred to this point earlier. So now, moving a little bit on to kind of showing again a little bit of creativity from the central bank community. Colleagues from the BIS produced what is called as this money flower. And I think as we keep doing our pilots, we might need to add more petals to this flower. So now starting to move a little bit on what are we seeing based on some statistics. This is a very recent report from the BIS, and I'm not sure whether all of you have seen it, but just to kind of point out some key highlights. We are seeing a rapid increase in the interest in CBDC. As you can see from the graph, from 2018 to 2019, there's been a rapid increase in the number of central banks which are interested and engaging in some form in the CBDC work. And I talked about earlier in terms of the two different uses, in terms of the retail payments as general purpose and then wholesale. And then also some central banks are, of course, working on both. And between 2018 and 2019, what we are seeing is central banks are starting to work on both of them, and there's a slight increase related to that. And in terms of what is the nature of work, experiments, proof of concept, and then some of them are engaging in pilot arrangements. So at this point, it is predominantly with respect to research, and of course, Ukraine is one of the few countries which actually went ahead and conducted a pilot. And this chart is very interesting in terms of the motivations for general purpose central bank digital currencies. And this chart kind of makes a distinction between advanced economies and emerging markets. And as you can see from this chart, the blue bars seem to be more in the higher category of they feel it is very important or important. And the areas which are being pointed out are financial inclusion, payment efficiency in the domestic context, and then also robustness and safety of the payments market. And as you can see, there's we are seeing differences between advanced economies and emerging markets. In the advanced economies, there's more interest towards the safety of the payments and robustness, versus in the emerging markets, it's more about inclusion and efficiency of the payment infrastructure. And this is, to some extent, is consistent with our assessment about the gaps in the payment infrastructures in emerging markets. If you look at the wholesale central bank digital currencies, a very similar trend. But there's an increased attention on safety and robustness in the case of wholesale CBDC. Now, in terms of what are the future plans with respect to CBDC here, and here we are seeing, as you can see, there's quite a bit of movement from 2018 to 2019, in particular in the general purpose central bank digital currencies. And there's a big increase in countries which are exploring CBDC, and which feel confident that in the short term they were likely to issue central bank digital currencies, and then also in the medium term. In the case of wholesale CBDC, we are seeing a shift more towards the short term. As you can see, there's a drop in the medium term for wholesale CBDC, but in the short term there's an increase. So there seems to be more momentum with respect to short-term implementation in the case of wholesale central bank digital currencies. In the World Bank survey on global payment systems, we had asked some questions related to, have you decided not to issue, when are you going to issue, and have you studied it, and so on. And what is striking is 15% of the central banks decided not to implement CBDC after having studied it. And a big portion of that, at least in terms of the percentages, has been in the high-income countries, and then also in the Latin American region. So this shows there's quite a bit of still the two camps are quite kind of strong on both sides. Now moving a little bit onto the risks, and I quote here Mr. Augustin Carstens. He had compared issuing central bank digital currencies to be equivalent to open heart surgery, and kind of talked about that there needs to be very close attention to the risks. And I'll talk about a little bit on some of the risks. So first is about financial stability, and financial stability risks are particularly more stronger if you start looking at wholesale. If you start looking at general purpose central bank digital currencies. In the case of wholesale, to some extent, all the commercial banks already hold accounts with the central banks. In some sense, the interactions with them are already digital, but that's not the case with respect to retail payments. And if you open up central bank digital currencies to the retail use, a lot of issues start coming up. And I'll just list a few questions, and of course, I don't have the answers to them, and I'm sure the colleagues who will come after me will elaborate on that. So firstly, will you remunerate central bank digital currency holdings, right? Will it be interest bearing in other words? And then will it be freely exchangeable with physical notes and coins, and also regular accounts held with commercial banks? And how will you determine the right amount of central bank digital currency? Then what will be the ability of the central bank to calibrate interest rate? How will interest rates be formed in the economy if central bank is issuing central bank digital currency, and in particular, if it's also interest bearing? And then what's the implications of the maturity transformation roles of the financial sector? What happens to money multiplier, and then things like that. And some of the recent papers from central banks and the BIS have concluded that these challenges can be managed. And however, they noted that additional research is needed. And it appears that the underlying assumption of all these studies has been that you can control how much of CBDC is issued. You can control the interest rate, and existing tools would be sufficient for that. But I think here one needs to take both a static and a dynamic view. and the dynamic view in terms of, in particular in times of crisis, what really happens to this whole dynamic. And this needs to be seen, and there is some experience with countries which had gone somewhere in this direction, like Zimbabwe, which had this digital version of their currency called RTGS dollar. And then what happens to that? They are not able to maintain the exchange rate between the kind of the 1:1 peg between the real currency, physical notes and coins, versus what is held in the digital form. And it kind of shows the challenges which will come up from a crisis point of view with respect to maintaining the parity and so on. But of course, more research is needed on that, and there seems to be enough tools to manage that, but I'm just flagging that. The next issue is respect to how central banks are perceiving some of these risks. Interestingly, this question again from the same BIS survey was asking central banks about, are you analyzing the impact in monetary policy of the global stable coins? And of course, many central banks said yes. And then if you look at who said no, a lot of emerging markets, 96% of the respondents who said no, they're not paying attention to the financial stability implications of global stable coins, were actually from the emerging market economies. And this is is an alert for the institutions like the World Bank and the IMF to really understand what's going on here. And in particular, some of these central banks are also engaged in the work on CBDC. And this shows that you're entering into an area perhaps without paying adequate attention to risk. And of course, in the case of Ukraine, the central bank has, of course, done a very good analysis of the risk implications, and I'm talking about in general terms with respect to emerging markets. Now, a little bit to push back on some of the points I talked about earlier in terms of the positives. So a lot of people talk about financial inclusion. So here it is important to really understand what is driving, what are the gaps in the financial inclusion, and what is really driving it. And if you see, we have a question in the Global FinTech survey, which asks what are the reasons why you do not have a bank account. And it's very instructive to see the reasons there. A good majority of them say it is because they don't have enough funds. Some of them say it is just too expensive. Some of them say they don't have enough documentation. And some of them say they don't have a need. So the question is, when you talk about CBDC addressing financial inclusion, the most basic financial inclusion service is payment services. And really, you need to understand how will CBDC address these issues. Accessing CBDCs in a most efficient form will require a smartphone. Of course, the penetration of smartphones is increasing worldwide, but some statistics from GSMA shows that in emerging markets, it's going to reach only 75% in about 5 years from now. So what happens to the 25% who do not have smartphones? How will it solve the issue of identity? How will it solve the issue of that you do not have enough acceptance points, right? So one really has to understand whether CBDC will address some of these issues when we talk about CBDC will address financial inclusion. The other point is CBDC has to be seen in the context of various other innovations which are happening across the world. There is faster payment services which are happening. There is also the SWIFT GPI on cross-border payments. There are regional integration efforts, and there's also this whole world of open APIs and so on. So let me show you one statistic from a BIS paper, not the one which I was referring to earlier. So this kind of plotted the progress of a few countries with respect to account penetration. And there were a couple of outliers, and one of them was Kenya, and the other was India. And Kenya, comparing to GDP per capita, it is way higher than the typical curve of how kind of account penetration increases as GDP per capita increases. And of course, in the case of Kenya, it is because of e-money and mobile money. And then the case of India, where it reached about 80% penetration in about 3-4 years from 2013. And that reason for that is underpinned by things like digital ID, open APIs, and then also significant investments in improving the domestic payment services. And some estimates talk about that it would have taken 47 years for India to have reached that particular point if it had followed the traditional course of development. And if you look at also the penetration of faster payment services across the world, this is also dramatically increasing, and in almost mirroring what happened with respect to RTGS systems, which had an inflection point somewhere about 5-10 years into the introduction of RTGS services. Then after that, it had a really rapid rise. And the question is whether services like fast payment services, combined with digital ID, open API, whether that is the more tried and tested for achieving financial inclusion, or do we need to go for CBDC? And my point is, at this point, it looks like, from a pure financial inclusion perspective, perhaps it is better to pay attention to these technologies where the opportunity is right at your hand, rather than looking at CBDC, which might be a little bit into the future. Then talking about, a lot of people talk about the price of international payments, the cost of international payments, and remittances in particular are very high and so on. Yes, they are quite high. And the gray chart shows that it reduced by about 3 percentage points over a decade, which is, of course, not fast enough. But at the same time, if you look at the green chart in the bottom of the slide, that shows the remittances done using mobile money. And that has shown that it is much lower, significantly lower from the global average, significantly lower from other mechanisms. And so it is possible to achieve lower cost for international remittances using traditional technologies, and this kind of proves that point. So I will conclude now by making a few points. Essentially, the key point I want to make is that the central bank digital currencies should really be seen in the context of various ongoing innovations. And CBDCs and stable coins and digital currencies are not the only game in town. There is also other technologies which are also making dramatic impact. The second point is that the CBDC will per se not address financial inclusion. It is neither necessary nor sufficient for addressing financial inclusion, in particular with respect to payment services. The other point I think has been made by several people, including the Honorable Governor. The central bank digital currencies require a significant amount of research, and cross-border payments, of course, need a lot of attention. And there's a need to step up international collaboration, and I'm very glad that the Ukraine is taking the lead in this, and conferences like these are very helpful in bringing up this global collaboration. I hope I'm within time, and with this I will conclude. Thank you.
Thank you so much, Harish. Thank you for such amazing global overview and for financial inclusion, especially this angle.